What's up, everyone? It's Eric with Option Edge, and today we're looking at Clover Health. Okay, so this was another meme stock that had a couple big runs. Here went up to almost 18. That was back in December of last year. Went down, then popped up around end of January, where a lot of these hot growth stocks sort of topped out in January, February, and then went straight down. And then you can see right around the $758. What we got here, 650. We sort of bottomed out, and then recently this summer, earlier in the summer, we hit a nice little pop there. So when these stocks make these drastic moves to the upside and downside, what's good about that is there's inherently a lot of volatility in the options. Okay, so there's a lot of premium to be had by selling either calls or puts. Okay, so let me turn on Bollinger Bands here just to give us helps me visualize the volatility here. So we're actually in a pretty tight volatility environment here where we haven't gotten much movement in the stock. We've been sort of just bouncing around here, and underneath right here, this is an indicator called the TTM squeeze. Basically, when the Bollinger Bands and the Keltner channels, that's another indicator. Let's look at Keltner. So basically, when the Keltner channels, let's erase this, the Bollinger Bands. So now we just have the Keltner channels. When the Keltner channels, when the Bollinger Bands go within those Keltner channels, that's a squeeze. Okay, so let's take off. All right, so here's the Bollinger Bands. All right, now we're going to put the Keltner channels on. You're going to see that the Keltner channels actually encompass or engulf the Bollinger Bands. So that constitutes a squeeze. Back here, we saw a squeeze back there, a major squeeze. You can see that the Bollinger Bands get super tight, and that means it's a low volatility environment, or we're just not getting a lot of price movement. And usually we either get a break to the upside or the downside. Okay, so I would put money on here that since we've already bottomed out after a lot of time, that I think, I'd like to think that we are headed up. Okay. And another thing, we've been in a pretty big bear market for growth stocks, even though the S&P 500 and the NASDAQ has been making steady climbs and hitting all-time new highs. Growth stocks, on the other hand, have really just plummeted. I think, and this is just from some people I hear, I think come November, around November time, October, November, and December, we're going to start to see growth stocks make a run. So there's two ways to play this. So one, you could buy calls, okay, that go out to November, like a $10 call, if you really want to get that convexity play. But I've been burned a lot in the last couple months, and I want a little bit less risk, less reward. So I'm going to simply sell puts. Okay, so I've been doing this with Lucid. I've been doing this with Palantir, and been having some good results. And what's great about this, when these stocks make these runs, then come back down, there's still what happens is there's a lot of premium in the options chain. So I'm just looking at Tastyworks gives us a little indicator 40. That is the IV rank. Okay, so it's the 40 percentile IV rank, which is pretty high. I'm actually going to check one more thing. Give me a sec. So I'm checking out something else. So I come over to Market Chameleon, and they also do a IV rank, and it's always different than Tastyworks. So I'm not sure where or how they're calculating that, but anyway. So 22 is a little bit low, but on Tastyworks, 40 is decently high. And actually, they have a little algorithm that gives you technical analysis, and it's saying that the stock is bottoming out and bouncing up. So that's a good sign if you're bullish on the stock. So another thing to do is what I like. I wish I could get this up on TradingView, but I can't. So something I've learned about options is when these stocks make these large moves to the upside, they make a round trip back to the downside. What happens is there's still a lot of premium in the options. Okay, so what we're looking at here is we have this green line, which is the let's look at here. green and red line. Okay, let me just. So the green line is the IV, okay, and the red line is also implied volatility. But so let's just focus on the green line, and then the purple line is the historical realized volatility. And what you can see is basically what we're seeing is that in reality, the historical realized volatility is actually lower than what the market is pricing. Okay, so what we can do with that is basically what it's showing us is there's a discrepancy in realized volatility and implied volatility. So we can take advantage of that discrepancy by being a net seller of options. Okay, so by selling options, puts and calls, we can we can profit. We have better odds of profiting. Okay. So what I'm going to do is based on the chart. I like the $8 calls. Okay. They're stocks at $8.50 just about. And what I'm going to only do, I looked in between, I'm looking at the September 17th. That's only 22 days from today, 21 days. And for $800, okay, by securing this put with $800 in 3 weeks, you can earn $55 of premium. Okay, and let's do a little calculation real quick. Let's get the calculator up. Hold on. All right, let's get the calculator up here. We got 55 divided by 800. Let's do times 100 just to give us a percentage that we can see. All right, so it's almost 7%. All right, so that's 7% return on capital in 21 days. So that's I'll take that. Okay, and if you were to calculate the yearly return on that, that would be over 100%. Okay, if you kept winning, that would be 100% return on the year if you just kept selling these puts. Over 100%, more like closer to 120%. I did the math before. So yeah, I like the $8 strikes, selling the puts. And the reason why besides the price and everything, I don't see us, let's say if the stock was to make a massive drop, I think we're not, here's the all-time low. I mean, could it always go lower? It could, yeah. But I think we've bottomed out. And I think, the best case scenario would be if let's say we got put shares and then this baby took off to the moon. But of course, I'd sell some calls around like $10 or something like that. This $10 strikes. So that's my plan for CLOV, for selling some puts, going to collect some extra premium and keep an eye on this one. Or besides selling puts, you could maybe take a little convexity play and buy some calls that are expiring later. What you could do, actually, this is just a new idea. So let's say we think this thing's going to pop. Let's say November. November. All right, what we could do is do a little risk reversal play where we sell the put. So first off, let's buy a call. We're going to buy a $10 call. Let's see how much those cost. $10 call. That costs $1.35. All right. To finance that $1.35, we could sell a 7.5, okay, put, and we got that on. We got the call. We sold the call. Let's go back to the call. We want to buy a $10 call, and then we're going to sell a 7.5 put, and you could buy basically for the total of $11. You could have a little risk reversal play where you're financing your call by selling a put. And as long as worst comes to worst, you get put shares at 7.5. That's not the worst situation ever, right? In fact, now that I'm looking at that might be a good play based on how the squeezes might play out. So, all right, well, those are my ideas. Hope you enjoyed this video. Like and subscribe. And as always, this isn't advice. It's just me messing around with the markets. All right. Peace out. Adios.